Welcome to Know Your Options, the Measured Risk Podcast.
The ultimate guide to navigating the volatile nature of the markets while managing risk purposefully.
Join us as we challenge the theory behind traditional asset allocation and dive into the mathematics of investing.
Whether you are a seasoned investor or just starting out,
this podcast offers valuable insights and practical advice to help you make informed decisions and manage your money wisely.
So grab a cup of coffee, sit back, and let's dive into the world of calculated risks together.
Hello, everybody. This is Larry Kriesmer, my partner, Bernard Surovsky. We're here today with Michael Garry, who's the founder and CEO of Yardley Wealth Management. And we're going to welcome him to the show right now. Mike.
Thanks so much for having me.
Welcome, Mike. And Mike, just to get things off to the start, tell us a little bit about your journey into the financial advisory business.
Sure. So I was working as a lawyer and I hated every second of every day. And at one of the networking events that the law firm made us go to, I met a recruiter from Merrill Lynch who told me my MBA and law degrees would be very marketable as a financial advisor. Turns out she was right. I hesitated to leave being a lawyer full time because I had just graduated from law school a few years ago, incurred a lot of student debt, and I'd worked at two firms, but not for very long, and really wasn't sure. My wife and I took a long walk on the beach, and thought, well, in either case, I could have an okay to an amazing career, and figured we'd give it a try. And I am so very happy that we did.
So a recruiter at Merrill Lynch got you off and running. That's a great story.
Yeah.
Go ahead, Larry.
Well, was it something you did right out of college, or like 2 or 3 years, or how long from?
No, so I didn't go back to law school till 4 years after college. So I was 29 when I graduated from law school. And then 2 weeks later, we had our oldest daughter. And so I worked for two law firms into, that would be like August or September of 98. And then I started with Merrill at the end of September 98. So coming up on 25 years.
Wow.
Crazy. Time flies.
So you got right when we had the first bludging with the tech bubble bursting, right? That was your introduction to financial services.
So I started in 98, but I didn't I hate these terms, go into production until like August or September of 99. And so, 4 or 5 months in, the market tops. And so I'm opening accounts and transferring accounts in and doing what I'm supposed to. And, every Tuesday they'd show you your numbers, and every, you'd open an account, and then the existing account, the value would go down. It was hard and humbling, to say the least.
Yeah,
it wasn't as bad as being a lawyer, though. So it's
Our experience was actually the whole namesake of the firm and the development of the firm was kind of forged out of that whole tech bubble. At some point, maybe we'll talk about this off camera at some point. But so back to you. You've been in this business for a good long time now, and you've raised a lot of assets. You transitioned out of being, let's say, a production type of person to an advisory relationship.
Yep.
But tell me, what frustrates you about our business or our environment right now?
Well, one of the things that always frustrates me about this business is like what I just said about production, in that so many advisors out there are so sales centric, let's say, and not enough care about like relationships and actually doing right by clients, and trying to learn all they can and use whatever tools are available. There's a lot of people in our industry that are just asset gatherers. They're good at getting people to sign on the line. And that's hard because I think that the rest of us who really try to do a good job for our clients, you get lumped in with them. I think people, that know that I'm a financial advisor are just like waiting for me to sell them something. And it does bother me. And that some of like the biggest names in our industry, it's because they have like magnetic personalities and they attract people to them. So that's an endless source of a little bit disappointment and frustration, but it is what it is, I guess.
So it's kind of that whole idea about a preconceived notion of what an advisor might be, not what an advisor actually is.
Right.
Yeah.
I think a lot of people don't know what we actually do. And, I think it's so straightforward. What, we do, we listen to them, try to find out what they're trying to do, see what they have and see what changes, if any, are necessary and help them make them. So it's not all that complicated to start anyway. But yeah, there's a lot of preconceived notions that are unfortunately, well, right, I guess, in some ways, but not right for those of us who really do try to do a good job.
Yeah. Well, yeah.
Best interest to, the legislation that's been coming through to try and sort of tiptoe up to the fiduciary standards that we have in our industry as an RIA. But, obviously, whenever there's a product company being sold, there's just going to be no way to necessarily say, well, there's some other product that's better or different.
Right.
Again, this whole podcast. Go ahead.
Wait, I was going to say, when we have people come in and we talk about the fiduciary standard, I think most of them really do think, if they haven't worked with an advisor before, they would just expect that whatever financial professional would put their interests first. And, I'd say, unfortunately, the vast majority do not have that standard.
Yeah.
And some have it sometimes. Why? How can you have a duty of loyalty and good faith sometimes? How is that a thing?
Right. Or up until the point that it benefits you a little bit more than the other things. So you need to go ahead and scale that way.
We have a philosophy of, take care of the clients and everything else will take care of itself.
Yeah. I wholeheartedly believe that.
Yeah. What is your vision for some of the changes that you'd like to see in the industry?
Well, some things are good, right? I think that there are some, there are steps it's in some colleges now have financial planning programs, and there are some firms where an advisor can come in and actually learn how to be an advisor without having to worry first about how they're going to get business. So I think those are good changes. Unfortunately, they're kind of small changes, and it's going to take some time for those to really take hold. There aren't a lot of financial planning programs, and some of the ones that are there don't really have a lot of requirements. It's a few courses, and it's not really like what you would need to know or to learn. And then it's hard. A lot of firms are one person, one advisor firms, where the having the resources to spend that time to train the next generation is a big commitment and sacrifice. So I don't know how it gets solved, but those are things that are giving me some hope and enthusiasm for the future.
Yeah, I personally have this kind of zealous appeal to try and get more education at the high school level. And I don't know why they don't have some kind of course on, basics of financial planning or basics of finances, even at the high school level as a mandatory course. It's a marvel that sometimes at the lack of just minimalist financial knowledge, even amongst highly educated people. It is pretty crazy thing. Is there anything about your business or about the industry to speak of that kind of keeps you up at night, or anything about, obviously not family related stuff, but more kind of business and or the industry itself?
Yeah. So for me, it's finding the next generation of advisors. I'd had a young woman here for a couple of years, and we had to part ways last week. And, it is hard to find somebody with the right skill set and attitude. And that's the hard thing. I really don't want to wind up selling this business to some roll-up firm in 10 years or 15 years. I really want it to go on, because we have relationships with clients that, I had that epiphany during the pandemic that, most clients are older than me. I'm 55, and there are a lot of clients in their 60s, 70s, even 80s. And if I just sell out one day, 10 years from now, that might be nice financially for me, but then it leaves a lot of people who are older and maybe, it's not that easy to find a new advisor when you're 86. And I really want that. So I'm going to try hard to build the next generation. And that's the thing about my business that is, that gives me the biggest pause that I worry about, because it's hard and it's something that I've never done before, and and I'm not 26 either, so it's a challenge.
Well, you have to find somebody who has a similar mindset to you that kind of says, "Oh, put the client first, and everything else will take care of itself." Kind of ideal, which is it's difficult. I mean, oftentimes you're better off starting out with somebody who might be a little more fresh than trying to retrain someone to shift their mindset.
Right.
That's good. Sorry, Larry, you had something you wanted to mention.
Well, let's talk a little bit about your portfolio recommendations. Do you use outside managers? Do you build your own, or some combination of the two?
Yeah, so we use mutual funds and ETFs primarily from two different companies, DF Dimensional and Avantis. So our investment philosophy is, asset allocation, low cost, tax efficient. Try to do those things and maybe, have a small tilt towards small in value and other things that those guys think make sense. So I use their help in building like basic portfolios for clients, and use their tools. I'm not a CFA, and I had a finance undergraduate degree that is very, very old now. So I take the advice where I could get it.
So, and from a risk management perspective, do they provide tools that allow you to kind of estimate what potential drawdown risk there may be, or what type of potential return might exist? Or
yeah, so they have tools for that, and then we use the tools in our software. And those are okay. I think that risk is one of the biggest things we struggle with. For me, for a lot of the way that I'll work with risk is to make sure clients have cash, in insured savings or in treasury, something that's got a guarantee, outside of the portfolio that we manage. And then within the portfolio, make sure that they really are okay with a lot of those ups and downs. And it's a struggle.
But I think that's been the struggle of sort of our observation, and that really is the primary thing, because ultimately the markets are going to go up over time. We know they're going to go up over time, and the only way to participate is to be in them.
Right.
I also know that in the short term, they can just get devastated, and trying to manage that kind of Herculean risk or catastrophic risk that could rear its head any time is I think where we as advisors deliver our value to our clients, and so it's definitely where we make our living or earn our living, I guess.
Yes, I remind myself of that every time we go through one of those periods like March of 2020, where it was just looking at the screen could make you nauseous. Remember, like that's the reason we get paid, or one of the big ones anyway.
Right.
It's kind of to hold the hands of your clients. So,
right.
Well, there's been, we started out in the Wayback Machine with individual equities that, brokers would advise people buying. And then we developed the 1940 Act came along, and we ended up with mutual funds and aggregated pool investments. And then we've migrated over to ETFs, where we have more, at least the ability to buy and sell, whereas the mutual fund, you have just once a day at the closing price. What do you see anything coming next? I mean, that might improve or create value there?
I don't know, but I like that timeline that you just said, because it is true. I was at a firm for 4.5 years after leaving Merrill, where I was for about 3 years, and he used a lot of individual equities. And then when I started here, we were all mutual funds. And then I'd say we're mostly ETFs now. And it just makes a lot of sense, for a lot of reasons, tax reasons. But yeah, I don't know. I mean, there's a lot of talk about direct indexing. I don't know if that really makes sense or not. Maybe in certain circumstances it could, if you have, I guess there's some ways that you can do portfolios now. If someone has a concentrated risk in a stock because of their job, you can mitigate some of that risk or try to change that. But yeah, I'm not really sure. What are some of the tools you've seen out there for trying to mitigate the risk in an individual position? Yeah. So some people use options and we don't do that. I'm not familiar enough with how that marketplace works. And there are the Dimensional and Avantis have tools where you could build a portfolio instead of taking their regular mutual fund or ETF portfolio. They can build a separately managed account portfolio with limiting the exposure to the industry or the specific securities to blend it for whatever the client has. So if you have a client who's a big holder because of options and RSUs or whatever in J&J, let's say, you can build a portfolio that has less exposure to pharma or J&J, using some of their tools and portfolios instead of just buying the mutual funds and avoiding that sector or something.
Right.
I don't know if I'm making that make any sense or not, but go ahead.
Yeah, it does. When you do business with the vendors you have now, is it directly on their platforms, or do you aggregate them through like a custodian somewhere? How do you structure your business?
Sure. Yeah. So we use Schwab and TD Ameritrade as our custodians.
Okay.
And unfortunately, that will soon just be Schwab right on Labor Day.
Do you have most of your business at Schwab, or is it mostly at TD?
It's almost always been split. I started when I left my last firm, used both, and I started with both. And over time, we have more accounts at TD Ameritrade, but the assets have always been just about equal. The accounts at Schwab have tended, the people who have had Schwab already tended to have larger accounts. And so we have fewer larger accounts at Schwab, but about the same dollar amount at both places.
Yeah, interesting. So, my experience with Schwab has been the customer service is pretty good. That the actual sort of hands-on is pretty solid, and there's more of an entrepreneurial spirit over at TD Ameritrade and helping the RIAs actually affect their business. So it's been interesting to be on both platforms as well.
Yeah, no, I totally agree. I'll miss the national link. And I'll they building out the APIs for the website forever, and then making the improvements to the website. And Schwab's website hasn't changed materially in a generation, but right. You call technical support, the Schwab reps tend to be more experienced and better at what they're doing. Mm-hmm. And so, There's definitely trade-offs with both of them.
Yeah, we'll look back at this recording and see whether or not this merger actually, pans out well for the end user, which is both us, RIAs, and
where we say, were we sage in our thinking, or were we completely?
How about do you do most? So you build your own volume. You're building allocations to these two vendors, and do you do financial planning services in addition? I loved your website, by the way, with the financial management and maybe a budget kind of thrown in there.
Thank you. And I stole that from somebody on Twitter. Somebody on Twitter said, everybody has this holistic wealth, blah, blah, blah. People want to know, manage my account, maybe save some money on taxes. And so, I saw that and thought, she's absolutely right. I'm going to take that.
It's very natural. I liked it a lot.
Yeah. Thank you. Yeah. And we are planning based. When people come in, we do a lot of planning and then update plans accordingly, really depending on what the client situation needs and how much the client wants it. For some, I think they tolerate it, and others enthusiastically embrace it. But I think that a lot of people like the idea of pulling everything together, going through the process. And I think for a lot of couples, I was just saying this to new clients the other day, I think for a lot of couples, they start to talk about big picture retirement items a little bit more, forcefully or in a more real fashion. Because a lot of people come in and think, oh, well, we don't know if we should buy another house or move to Florida, or our son lives in another city. And I think that the planning process gets them thinking a lot more actively, and they'll start the conversation. And I don't take part in oh, you should live here. But I think it's good to see, and I think it's a great process. A lot of people go through their lives, just like paying the bills or buying their funds or managing their 401k without really thinking about an overall plan and what they're trying to accomplish. And I think when people have that, it gives them a lot of peace of mind and a purpose. And so, if you say, okay, well, what we're doing is we're saving in these 3 different buckets and we're saving this much, and we kind of have an expectation of around a certain amount of return. And if we do that, then these goals in our future are more likely to happen. It makes it a lot easier, I think. I think it really, again, I guess because we've been doing it for so long, it doesn't seem too complicated. Doesn't seem like rocket science, but the actual act of doing it, I think, is really, really valuable.
Yeah.
Yeah.
Well, Bernard is a fan of saying, if you don't know where you're going, any road will get you there. So
that's right.
That's kind of key to really what we do and trying to help people achieve goals instead of just putting into a bucket. Yeah, exactly.
When I worked with my last boss, and he was buying individual stocks. And, and this is, again, another small firm like us. And with trying to figure out which 30 to 50 stocks clients should have, we had to allocate a lot of resources to that. And I don't know that that was an effective use of those resources, because instead of doing that, we could have been trying to talk to people and going through their tax return and making sure they were saving enough, making sure their beneficiaries were correct, make sure they updated wills and estate planning documents, all the things that I think of as like the blocking and tackling of being a financial planner, a financial advisor. We didn't do, because he was trying to see whether like Coke would do better than Pepsi over the next year, and it just seemed to me like a backwards look at priorities.
Yeah. In that respect, we are completely aligned. There is such a compelling desire for the public to be able to find somebody who will claim to be able to look at either stock investment reports or earnings reports or potential, anything, some sort of data set, including charts and graphs and pictures and things, and come up with some solution on what is the future going to hold. And Bernard and I threw in a towel on that, actually probably back in 2005. Probably coming out of the financial crisis and really getting, not the financial crisis, but the tech bubble initially, and just realized that all things considered, it's impossible to figure out what's going to happen in the future, and at least particularly in the next few months, it's going to be very difficult. So we're definitely aligned there. I think the key is to put money away, aim it toward a goal, and do your best to manage risk. But there's a ton of investment choices out there, and at the same time, people feel like they maybe don't have the right choices. So it's an interesting world to be in. And so we want to create this podcast so that investors can know more about what their investment options are. And if we had basically a choice or something, if you could pick a choice, what would the perfect characteristics be of an investment strategy?
I could pick the choice. So first, I guess you need to know like what the risk parameters make sense for you, right? So is this something that has an indefinite lifespan, like a charity, or is it for your retirement, or is it for a shorter amount of time? Yeah, there are so many questions about risk. That's the hard thing. Once you figure that out, though, I think you look for things that are like, what are the return expectations compared to like the world? And then what are the costs and taxes associated with it? And so that informs a lot of our investment philosophy. I think there's a lot of different ways that you could do things. And my approach is to spend a lot of time on the planning, and then buy different funds that go into different asset classes that make sense to invest in, and do that cheaply and tax efficiently to the extent that you can, and look at it, like as a whole thing. Like, so there's no one part of that really like runs everything. Just because it's the cheapest doesn't mean it's the best. Just because there are no taxes doesn't mean that's the best. You need to look at everything, like the expected returns. Maybe the volatility matters to you. And for some people that matters a lot. For me, it doesn't matter. But, I started my firm with no clients and really no prospects, and with a wife and 3 little kids. So I understand that my risk tolerance is pretty high. And so other people would have probably a low. Some people have a much higher risk tolerance, but most people would have a lower risk tolerance.
So, Mike, I have a question. What if there were an investment out there where you, as the advisor, could get to kind of set the risk parameter, knowing that there would be an unlimited upside, but obviously the upside potential would be capped, or not capped, but limited by the amount of downside risk? Is that something that would be of interest to you?
Sure. And I know there are different types of some of those products, but I don't really know them all that well anymore.
And what if something like that were completely transparent and liquid? Is that something that would make it more interesting to you, or kind of?
It sure would. Transparent and liquid? I like those.
Mm-hmm. Transparent, liquid, and with government protections around the bulk of the assets.
Sure.
All right.
Great.
Well, we've talked about the industry, some of the movements, and what's happened over the years. We've talked about your experience in developing your RIA, your I guess, desire to work with clients and help them set up the goals and things. Is there anything else we should have asked that we didn't ask today?
No, I think this was great. I love the questions, the way this went. This was a very enjoyable time.
Cool. Great. Well, unless there's anything else, we'll wrap it up today, short and sweet, and we'll get people back onto their cars or onto the next task. And appreciate you spending time with us today, Mike, and wish you best of luck.
This interview also may contain statements that constitute endorsements of measured risk portfolios, also known as MRP. Please note that any such statements are not made by clients of MRP, but by representatives of other investment advisory firms that work with MRP. No compensation was offered or given in exchange for these statements. However, a conflict of interest exists due to the incentive to give an endorsement in the interest of a good future working relationship between the endorser and MRP.